Hey guys, welcome back to Financial Fitness, where we discuss strategies and techniques to help you make better financial decisions. And with the 2020 election fast approaching, we're going to discuss how elections typically affect the stock market. Keep in mind that this is not financial advice, and I'm also not telling you who to vote for in this upcoming election. Those are decisions you should make on your own based on your research and your educated analysis. However, I'm going to share with you guys my analysis and what moves I'll be making in the stock market. Without further ado, let's jump right into the video and learn from historical events and historical data how election years affect the stock market and the economy as a whole. With this knowledge, you can position yourself for long and short-term success within the stock market. First, both candidates couldn't be any more different. The Republican nominee and current president, President Trump, and the Democrat nominee, Joe Biden, are very different in both personalities and beliefs. Similar to back in 2008, where President Obama went against the Republican candidate, the late John McCain at the time, and he won. President Obama inherited a terrible economy which was in recession at the time in 2008, caused by the housing bubble. And through monetary policies like quantitative easing, he was able to take us out of this recession. For those of us who might not know what quantitative easing is, this is a very controversial monetary policy where the federal government, obviously through the central bank, purchased actual securities and assets on the open market, which is the stock market. Opponents of this policy claim it defeats the goal of capitalism by defeating a free and fair economy. However, regardless of how you or I feel about this policy, there's no doubt about its effectiveness in boosting or stimulating the economy. This is because as the government keeps pumping money into the economy through the stock market, the prices of goods, assets, and securities in the stock market tend to keep going up. This strategy of monetary policy was responsible for the bull run back in 2009 all the way to 2016. And Trump right now is a huge supporter and a huge enforcer of this quantitative easing policy. President Trump wants to continue quantitative easing aggressively as it helped save us from the 2008 recession, which was caused by the housing bubble, and it also helped us avoid a possible recession or depression that would have been caused by the coronavirus outbreak back in March, where the stock market fell down. Trump seems to be really focused on the stock market, but keep in mind that the stock market looks to the future, so it's not a perfect indicator of the economic situation in the country today. This means that although the markets, such as the Nasdaq, has reached all-time highs, our economy is still kind of down. Trump's second monetary policy to help stimulate the economy is his tax cuts for corporations and big businesses. Back in 2014 to 2017, under President Barack Obama, the stock market growth started to slow down. This is because President Obama was kind of easing up on quantitative easing, pun intended, and as a result, the market and the economy started to slow down. This is because we had already recovered from the recession of 2008. A second reason why the stock market started to slow down and kind of hover around the region was because there was so much uncertainty on who was going to win the 2016 presidential election between Trump and Hillary Clinton. Investors hate uncertainty. Uncertainty causes a lot of volatility in the market, but once all the uncertainty is figured out, kind of like the election of 2016, after Trump won, the markets pick a direction, either going up or going down. This can be seen from 2016 to 2017 after Trump won the election and enacted his tax cuts. Tax cuts signifies bigger profit margin for both investors and big corporations. Bigger profit margin signifies low PE ratios, which signifies really good deals in the stock market for investors to jump in and buy some of these assets and securities up. Between November of 2016 and 2018, you can see an almost exponential increase in the price of the stock market. This was under President Trump and his monetary policies. Biden, on the other hand, actually wants to decrease quantitative easing. This is actually not a bad idea to myself or other investors, as this extra government money is going to be sent out to the middle class and the lower class, which is where I fall. So more money, more Chris, more happy Chris actually.
Boy, if you don't...
While Biden's policies might be bad for the stock market in the short term, I think it's excellent for the stock market in the long term. This is because this extra money sent out to lower class and middle class are going to be spent. The middle class is the backbone of the economy, and the lower class loves to spend money. Spending money boosts the economy, and a fat economy signifies a fat stock market. Biden also wants to hike corporate taxes, which in the short run would signify shrinking of company earnings, which signifies overpriced stocks or overpriced assets in the stock market, forcing investors out of the market in the short term. But in the history of the stock market has always performed extremely good when the Democratic president is in the White House. In all elections since 1993, the markets have gone up 82% of the time after the election within the first year of a new president, regardless of if it's Democratic or Republican. But it goes up higher for Democratic presidents, especially when it's a Democratic president with a Republican Congress. That has always gone up historically in the stock market. Keep in mind that historic events in the stock market don't necessarily predict the future of the stock market. So this is why it's important for you to do your own research and make your own decisions on what to do with your money and what to do with your voting card, who to vote for. However, the stock market has been the single most effective means of predicting who wins an upcoming election. Over time, it's been right over 90% of the time. Here's how it goes. If the markets continue to rally all the way into November, which is the election month, there's a high chance that the current president is going to stay in office, signifying a win by President Trump. However, on the other hand, if the market stagnates or start to fall, there's a high probability that there's going to be a change in office, signifying a Biden win. I personally believe the stock market will continue to go up long term regardless of who wins. This is because America is a great nation and it's stupid to bet against America, because America will always keep growing. I'm not saying this is my preferred outcome, but I honestly believe if every eligible American goes out and actually votes, Biden will most likely win. This, however, signifies a bad short-term direction for big tech stocks like Microsoft, Google. I believe if Biden wins, they will fall in the short term due to his corporate taxes. So here's what I plan on doing. I currently own Apple, Microsoft, and Facebook shares. However, I do plan on getting rid of one of those three before the upcoming elections, depending on how things look in the market between now and November. I'll most likely get rid of my Facebook stocks. This is because I currently have about $12,000 in Facebook, but over the past 2 months, Facebook hasn't been going as good as I think, but it kind of picked up here recently. But again, like I said, it all depends on how the market plays out between now and November. However, I never plan on completely leaving the market. This is because studies have shown that if you miss the best 10 trading days in the market since 1930, you're only going to average a return of about 97%, which is not bad. But when you compare it to a 15,000% return you would get if you are in the market for the best 10 trading days since 1930. So I have no plans on leaving the stock market. So moral of the story, keep investing consistently and constantly. Never completely leave the market. That's it for the video, guys. I hope you guys enjoyed it. If you did, go ahead and like the video and subscribe to my channel. If you haven't done this already, I'm going to see you in the next one.